Hey everyone, this is Bjorn with Quarry Hill Advisors. I wanted to talk about some of the significant tax law changes that have taken effect this year. On July 4th, President Trump signed the One Big Beautiful Bill Act into law. This legislation makes permanent many of the tax cuts from 2017 that were set to expire. It also introduces a few new provisions that's going to affect our tax planning strategies. The big picture is that your tax rates are now permanent. With this change, rates would have increased substantially in 2026. The top rate is going to stay at 37% instead of jumping to 39.6. This gives us a lot more certainty when planning your long-term tax planning strategy. It's a 900-page law, so there is a lot here. But I wanted to walk through what we consider to be the 5 most important changes for high-income families and professionals. So first off, the state and local tax deduction is going to increase from $10,000 to $40,000 starting now in 2025. So previously, if you paid a lot of taxes to Minnesota, you were limited to only $10,000 in terms of a deduction. So even if you paid $40,000 in income taxes and $10,000 in property taxes, you could only deduct $10,000. Now that limit jumps up to $40,000. So a lot more people are going to be able to deduct their state and local taxes going forward. So this is going to go up by 1% per year through 2029, and then in 2030 it will drop back down to $10,000 unless they change the law again. Now, there is a catch. If your adjusted gross income exceeds $500,000, then this deduction is going to start to phase out and it's going to be completely gone if you're at $600,000 in income. So for example, let's imagine there's a family and they live here in Minnesota, and we'll call them the Johnson family. They earn $450,000 and they pay $35,000 in state and local taxes. Well, under the old law, they could deduct $10,000, but now they can deduct the full $35,000, which is going to save them about $6,250 in taxes this year. So it's a big deal. Now let's consider another hypothetical family. We'll say the Smith family. They're going to earn $550,000 and they're going to pay the same $35,000 in state taxes, but their deduction is going to get reduced by $25,000 because of the phase out. So it saves them $3,750, which is great, but not as big as the $6,250. If you're one of our clients, don't worry, we're going to go through this for you personally and figure out what that means. If you don't have a good financial advisor who's going to help you with this, feel free to set up a meeting with one of our financial advisors. All right, let's talk about a second big change, charitable deductions. Now, you know I'm a big fan of giving money to charity and helping other people out. So there's a couple of changes here that are going to affect things. So first off, the good news. The good news is if you are single, you can now deduct $1,000, or if you're married, $2,000 if you are taking the standard deduction. So if you just deduct what everyone deducts where they don't really have any deductions, but you made a small charitable deduction, now you can get a little help there. So that's great news for a lot of people since most people don't actually itemize their taxes. It's also great news for charities because small donations can now help them again. Now there's some challenging news, of course, that goes with that. So if you do itemize, you can't deduct the first 1/2 of 1% of your adjusted gross income on charitable contributions. And then for a couple of $300,000 or more in income, the first $1,500 of charitable gifts won't be deductible. Let's go through an example on that. The Davis family is going to earn $400,000 a year, and they normally give around $8,000 to charity. Pretty generous. Good job for them. Under the new rules, they can't deduct the first $2,000. That's 1/2 of $400,000. So only $6,000 is going to be deductible. So that's going to cost them an extra $1,480 in taxes. So one way we could maybe get around that is to have someone bunch their charitable giving. So instead of giving $8,000 per year, you give $16,000 one year, 0 the next, and then $16,000. So that way they get to deduct $14,000 in that giving year, and then they can take the standard deduction in the off year. So depending on your circumstances, that might be a good way to kind of help offset that limitation. Okay, so the third big change is the exemption for the estate and gift tax. So starting in 2026, the estate gift tax exemption is going to increase to $15 million per person. That's up from $14 million today. So for married couples, you could transfer $30 million during your lifetime or at your death without paying any federal estate taxes. This exemption was scheduled to drop all the way down to about $7 million per person at the end of 2025. And so instead it's jumping all the way up to 15, and it looks like it's staying there permanently. So for business owners, this is a really valuable change. Now you can give $15 million worth of business interest to your children at your death or even during your lifetime, where you could potentially remove some of that future growth from your taxable estate. So if you're considering wealth transfer strategies, this is going to give you a lot more room to work with. The fourth big change we have are deductions for those who are 65 and over. So starting this year, if you're 65, you get an additional $6,000 deduction per person. And this is going to apply whether you itemize or whether you just take the standard deduction. This deduction, of course, like a lot of the others, is going to phase out if your income gets too high. So for single filers, it's going to start to phase out at about $75,000, and then it'll be completely gone at about $175,000. For married couples, that phase out is going to start at $150,000 and then phase out at about $250,000. So let's do an example on this. So let's say you had Robert, who is 67. He's single and has about $100,000 of income. His deduction is going to get reduced from $6,000 down to $4,500 because he's $25,000 over that phase out threshold. So $25,000 times 6% is $1,500 reduction. So that's still going to save him about $1,000 in taxes. So there's still some value, even though there's a little bit of a reduction there. For married couples where both spouses are 65 and older, the potential savings are, of course, doubled. So a couple with $175,000 in income would still get about a $9,000 deduction, which, reduced from the $12,000 due to the phase out. That's going to save them about $2,000 in taxes. So again, a nice break for them. Now, to make the budget work, they do have this expiring on January 1st of 2029. So it's a temporary relief unless they're able to somehow extend this. Okay, now the fifth big change is going to apply to executives and other professionals who have stock options and restricted stock units. Let's start with ISOs, or incentive stock units, and AMT, which is the alternative minimum tax. The higher state and local tax deduction can actually backfire a little bit and make it more likely that you're going to trigger the alternative minimum tax when you exercise your incentive stock options. This happens because the state and local tax deductions get added back into your income when you are calculating your alternative minimum tax. So let's look at an example here. Let's say you have Sarah, a tech executive who plans to exercise her incentive stock options with a $150,000 spread. Previously, with only a $10,000 state and local tax deduction, she could have stayed under the alternative minimum tax threshold. But now, with a $35,000 state and local tax deduction, she's more likely to trigger the alternative minimum tax, reducing the number of incentive stock options that she should exercise. So there are more AMT changes coming in 2026. Starting next year, the alternative minimum tax becomes more aggressive for high earners. The exemption phases out faster and even at lower levels. For married couples, that phase out is going to start at $1 million instead of the current higher threshold. With the state and local tax deduction phase out starting at $500,000 and the alternative minimum tax changes coming in 2026, timing your stock option exercises and your restricted stock unit sales becomes critical. A large vesting or exercise that pushes you over the $500,000 limit could really cost you part of your state and local tax deduction. So for those who are in startups or in IPO companies, the qualified small business stock rules got even more favorable. The gross asset test increased to $75 million and the capital gains exclusion rose to $15 million. The holdout period does become a little bit more flexible as well. So there's a 100% exclusion for shares that are held for 5 years, a 75% exclusion for shares that are held for 4 years, and a 50% exclusion held for 3 years. So for example, if your startup company qualifies for this and you exercise options holding the shares for 3 years, you could exclude 50% of your capital gains from federal taxes. So let's go back to charitable deductions for a moment, because it particularly affects those with equity compensation. The new 0.5% AGI floor on charitable deductions is big. If you typically donate company stock to charity, you might want to bunch those deductions to exceed the floor in years where you have a large stock option exercises or the RSU vesting. Beyond the major changes I just outlined, there are several provisions that also deserve your attention. First off, for tips and overtime, Workers can now deduct $25,000 in tips and $12,500 in overtime pay, or $25,000 for married couples. Those deductions phase out for high earners, but it could benefit young children or employees. There's also a new type of savings account called the Trump Savings Account, and parents can now contribute $5,000 annually to this special account for children who are under age 18. There's no deduction for it, but growth is tax deferred until age 18. So we can talk about where that fits into your savings strategy and whether that's better than a 529 for you. Just reach out to our office and we can get through the details on that. There's also a cool thing where 529s are being expanded a little bit. So you used to be able to give $10,000 from your 529 to pay for elementary school and high school. That limit has now been raised to $20,000. Another change is the dependent care benefits. So the dependent care FSA limit has now increased from $5,000 to $7,500. And starting in 2026, you can claim 50% of qualified expenses instead of being limited to 35%. Another change, kind of a bummer, is that energy credits are ending. So most energy credits are going to expire by the end of 2025. So that includes credits for electric vehicles, solar panels, and home efficiency improvements. So if you've been considering doing one of those things, you should act now. Last of all, there's other business provisions. The 20% business income deduction is now permanent with higher income thresholds. 100% bonus depreciation is permanent for equipment that was purchased after January 19th of 2025. And then research and development expenses can be immediately deducted starting this year. Okay, that was a lot. So what does this mean for you? I think these changes merit a review of your strategy. Some people are going to benefit immediately. Others may need to adjust their approach to maximize the opportunities. In our next planning session, we're going to talk with all of our clients about how these rule changes will affect you. But please don't hesitate to reach out if you have questions. The permanent nature of these changes is going to give us certainty that we haven't had in quite a few years, but the temporary nature of a lot of these provisions are going to create some time-sensitive opportunities that we don't want to miss. Thanks for your attention, and I'm happy to answer any questions you have about this. And please reach out if you would like a review of your own finances.